Benjamin Graham and David Dodd security analysis is one of the classics in investing and security analysis. First published in 1934. This book has had a profound impact on the investing world and helped form the foundation for the value investing strategies we see in investing today. With a deep understanding of the stock market, Graham and Dodd offer financial analysis methods that are long-term and sustainable. Below are the important lessons from this book, divided into several sections for you to easily grasp. 1. Value investing and the difference between investing and speculating. One of the highlights of the book Security Analysis is the concept of value investing. Graham and Dodd emphasize that investing is different from speculation. Investing requires careful analysis and investing in companies with superior intrinsic value, while speculation is based on short-term changes in stock prices without a solid foundation. Value investing is the search for stocks that are priced lower than the intrinsic value of the company, are undervalued by the market but have the potential to grow in the future. Speculation, on the contrary. Speculation is the act of buying and selling stocks based on predictions about short-term trends, rather than analyzing the real value of the company. Lesson: investing must be based on careful analysis and investing in stocks that have real value, not just because the stock price may increase in the short term. 2. Deep financial analysis and use of financial statements. Graham and Dodd go into great detail about how to analyze financial statements to evaluate a company. This analysis is not only based on the stock price but also considers fundamental factors such as financial statements, earnings situation, debt and other financial factors. Financial statements: investors need to read and analyze financial statements to assess the financial health of the company, including the balance sheet, income statement and cash flow statement. Financial ratios: important indicators such as debt-equity ratio, profitability ratio, and ability to generate stable cash flow are factors that help assess the company's future growth potential. Message: to invest effectively, you need to read and understand the company's financial statements, from which you can make investment decisions based on fundamental factors. 3. Buy stocks when the value is lower than the intrinsic value. Graham and Dodd emphasize an important principle in investing: only buy stocks when their market value is lower than their intrinsic value. They call this margins of safety. When a stock is sold for less than its intrinsic value, investors can minimize risk and have the opportunity to make a profit when the stock price adjusts to its intrinsic value. Margin of safety is the difference between the intrinsic value of the stock and the current market price. The larger the margin of safety, the lower the risk. Buy when the price is cheap, when the market underestimates the intrinsic value of the company. This is a good opportunity to buy stocks at a cheap price, minimize risk and potentially make a profit when the stock price increases. Lesson: to invest successfully, look for stocks with high intrinsic value but selling for less than their intrinsic value. Make sure there is a margin of safety to minimize risk. 4. Analyze the industry and business conditions. Graham and Dodd also mentioned the importance of analyzing the industry and business conditions of the company you intend to invest in. The stability and profitability of a company depends not only on the company itself, but also on the industry environment in which the company operates. Industry analysis: it is important to assess the level of competition and sustainability of the industry in which the company is participating. A company operating in an industry with strong growth potential will easily achieve high profits. Business conditions: macro factors such as the political situation, the economy and industry trends also greatly affect the performance of the company. Message: a thorough analysis of the industry and business conditions will help you better understand the company's prospects and future profitability. 5. Focus on long-term value, not short-term fluctuations. Graham and Dodd encourage investors to focus on finding long-term value instead of getting caught up in short-term fluctuations of the market. They believe that the market may fluctuate greatly in the short term, but the true value of the company will be reflected in the long term. Long-term investing, instead of focusing on short-term fluctuations in stock prices. Invest in companies with strong financial foundations and long-term growth prospects. Patience. Value investing requires patience. You need to wait for the true value of the stock to be recognized and reflected by the market. Message. Invest in stocks with strong intrinsic value and wait patiently for that value to be recognized by the market. 6. Manage risk and choose investments carefully. Finally, Graham and Dodd emphasize the importance of managing risk in investing. To minimize risk, you need to have a careful investment strategy and only choose stocks with high financial security. Risk management. Investing always has risks. But you can minimize risks by allocating your investment portfolio reasonably and choosing stocks with stable potential. Carefully choose stocks. Choosing stocks is not only based on profit potential but also ensuring that the company has a solid financial foundation and is less affected by external factors. Lesson: to minimize risk, you need to manage your investment portfolio scientifically and choose stocks with high financial security. Conclusion: the book Security Analysis by Benjamin Graham and David Dodd laid the foundation for the value investing school, helping investors understand how to analyze financials and determine the value of a company. Lessons from this book include focusing on fundamental analysis, investing for the long term, minimizing risk, and looking for opportunities with a high margin of safety. Key messages: investing must be based on analyzing the intrinsic value of a company, not short-term market fluctuations. Use financial analysis to make informed investment decisions. Long-term investments in companies with intrinsic value will yield sustainable returns.